Welcome back to the exchange. Tech looking to regain its footing following a big slide in September. But even with that drop, the tech sector is still up 28% year to date, and investors are still bullish on it. Our CNBC fourth quarter stock survey shows 64% of investors believe that tech will lead the market next year, outpacing others like industrial and consumer discretionary. Between that and the flood of IPOs lately, are we in an environment precariously similar to the dot-com bubble in 1999? Joining me now is Brook, Dane, portfolio manager at Goldman Sachs Asset Management. He's the co-lead portfolio manager of Goldman's Technology Opportunities Fund, which is up 30% this year. Brook, it's good to have you back. Do you see parallels here or not?
Hi, Kelly, and thanks for having me back on. So, we do think we're in a very different environment now than where we were in 1999. And, a lot of that is driven by both the fundamentals of the companies and the valuations that we're looking at right now. So while it's been a great time to be invested in tech, we remain very bullish about the outlook across the intermediate term.
Now, listen, I know we're nowhere near, kind of the crazy, hey, this company was formed in 2 weeks and it's going public and it has no real business plan and, the stock is up 100,000%. But there are some areas where you look and you say, okay, there are some electric vehicle SPACs that feel like they're raising money based on a business plan. There's all these new types of IPOs and appetite for them. And the performance has been really solid. And the tech sector itself has some companies trading at, Apple most notably, it's like the biggest company in the world, and its PE is basically the highest that we've ever seen. So how would you explain all of that?
Sure. Yeah, so when we look at the market, first off, what we'd say is that, there's real lessons to be learned from how we came off the last bubble and how, how stocks reacted and how investors should be positioned as we see it right now. There are pockets of the market where the valuations are concerning and there's some speculative activity going on. On the other hand, at Goldman, we're finding great opportunities to put capital to work in companies where we think the market is just, underappreciating what's happening in the underlying businesses. We think that, as we've talked about before, there's a real wave of innovation that's broadening out beyond the headline names that you see all the time, the big mega cap names or some of these new IPOs. We just think that there's tremendous opportunities. And, we always are, one of the great things about working at Goldman is the clients that you meet and the opportunities you get to discuss what they're trying to do with their portfolios. And effectively, they've trusted us with their assets. And, we take that trust very seriously. So we're always looking at both the upside that we could generate from an investment as well as the downside risk that's involved. Yeah. And, I think
Tell me about
our process really is driven by that. Go ahead. Sorry.
Fair enough. No, absolutely. Tell me about Splunk and Palo Alto Networks, which are two of the companies that you think are worthy investments here. Why?
Yeah, so both of those companies have a little bit of controversy happening right now that is creating an opportunity for investors to take advantage of what should be, very solid fundamentals going into the next year, and valuations are very attractive. So starting first with Palo Alto, Splunk, I guess is up on the chart first. There's a company that's going through effectively two different business model transitions as we sit here today. So they're moving from a perpetual and term-based business model into more of a subscription model. At the same time, they're moving to cloud-based software as well. Both of those things are depressing near-term revenues, but are building up real value on their balance sheet and are going to lead to a much more predictable, sustainable business as we move forward. Similarly, with Palo Alto, there's when you look at the security market overall, security is going through a transition where there's a new generation of security technologies out there. It's called zero trust. And effectively, the architectures that design the security paradigms in the old world are fundamentally changing. Now, Palo Alto has some great assets that are addressing the zero trust market, but at the same time, their core firewall business is actually proving to be resilient. It's just shifting from being more of a software model more of a hardware model to a software model as we see it here today. So in both of those names, we find real opportunities and excitement in the businesses.
And no, and it's a great explainer of how you can still find value in a market where people are eager to kind of lump it all in as, FANG and everything else. And I also think it's interesting, we have to go, but you say that another difference with the market now versus 1999 is if you took tech out of the picture in 99, the fundamentals looked okay. And I know you're much more cautious and skeptical about a lot of the so-called value parts of the market today and whether there is going to be value there. Brook, we'll leave it there for now, but we look forward to chatting again soon. Thank you for your time, sir.
Shepard Smith here. Thanks for watching CNBC on YouTube.